Welcome to the B.F. Anderson Technical Report for December the 30th. Recent report out by Mike Centolo of Cabot, which is a really fine research firm up in Salem, Massachusetts. The title of the article is Growth Stocks Poised for Banner 2017. Now, growth stocks are a unique sector of the market where you're looking for growth of revenues, growth of earnings, quality of balance sheet. You want to make sure that the story is solid. You want a good story where people understand that there's future. The main story that I like, though, is where a company is in a proprietary position where they don't have a lot of competition. The numbers need to be good. You need to see numbers in the magnitude of at least 10% growth rates, 15% better, but the higher the number, the better. Now, one of the reasons growth stocks have performed poorly in the last, say, 8 years is that when there's a lot of uncertainty in the market, people will seek out companies that have very low growth rates but very predictable growth rates. No one wants to take a chance on something that could grow 15%. But as the economy improves and confidence starts to come back, that all changes. So what Centolo is saying in the report is that he's seeing signs of that activity. Now, he points out here something I think very important. He says, as a whole, growth stocks have made no progress from March of 2014 through November of 2016. So, growth stocks have pretty much missed a big part of the rally because of the uncertainty issues. And if that changes, you've got a tremendous amount of potential here because these stocks have lagged. The longer the base, the greater the race. Well, in the report, he mentioned several sectors that he would pay attention to. One sector would be the biotech stocks. He mentioned Celgene and Insight. Another sector that he would recommend that we look at would be networking stocks, which would be companies like Arista Networks. He also mentions restaurant stocks, and in the restaurant area, he favors companies like Dave & Buster's and Jack in the Box. Excuse the cursor. As we move on, and if we look at a chart of the Russell 2000, which is the small cap growthy area, or even the NASDAQ, you will see that there is almost a flat line between March of 2014 and November of 2016. So these stocks are due for a move. We move on, and I think the most interesting part of the report was his reasons why he thinks Tesla could be back in 2017. Now, recently Tesla, just so that you're aware of this, Tesla signed a $256 million deal with Panasonic, which is going to create 1,400 jobs in Buffalo, New York. Now, these are going to be to make solar panels. Now, earlier in the year, there was a lot of controversy over Tesla acquiring a sister company called Solar City. But my instincts are telling me that it has something to do with a $256 million investment from Panasonic. So maybe it wasn't a bad idea after all. The main catalyst that he is pointing out is the Model 3 launch, which is an affordable electric car. They've got 373,000 deposits already. Now, that's a big number. I mean, that's more cars sold than BMW 3 Series, Mercedes-Benz C-Class, Acura TLX, and the Lexus IS combined in 2015. So the story is interesting with regards to the Model 3 launch. His second catalyst is that he's noticing that sales are accelerating. Quarter by quarter, they're selling more Model S's than the prior quarter. That's a very good sign. Now, on a technical basis, he is noticing that the stock price is starting to move. So in conclusion, what he's saying is that he thinks that Tesla may be in a recovery mode for 2017. It's certainly something we're going to keep an eye on. So thank you for your time and have a happy new year. And if you have any questions, let me know.